My name is Obafemi Oyewumi. I welcome you once again to another class of taxation. We're looking at theory of management of taxation basically as the course, and then the topic is history of taxation in Nigeria. At the end of today's class, students are expected to know the history of taxation, how it was practiced in the colonial era in Nigeria, and of course the modern trends in taxation in Nigeria. Let's start with history of taxation. Before we start, I would like you to subscribe, and I also want you to like my YouTube page so that you'll be able to have opportunity to see, and to be part of the next class, other releases that will be made, via this medium. Now we're talking about history of taxation in Nigeria. Taxation in Nigeria predates the colonial era, and that's to say that even before the coming of the colonialists into Nigeria in 1861, taxation had been in existence, but then it was done on ethnic basis. Okay, it was done on ethnic basis. The Northern Kingdom, the Yoruba Kingdom, the Eastern, Southeasterners, they had their own way of taxing their people. So it was done basically on that the platform. Okay, not anything formal, but then there was already taxation even before the existence, even before the coming of the British in Nigeria. And let's begin to look at those things that were done, those things that they were doing then in form of taxation. In the north, they were collecting what is called zakat, a tax levied on Muslim for charitable and religious and educational purpose, kudi kasa, and a cultural tax for land utilization, and jagali, a cattle tax levied on livestock, and shuka, and then that means a tax for cattle rearers. In the southwestern area, they were collecting what is known as a shakole, and of course owo ori. That's tax paid by every individual in the community to the government. That they were paying to the obas then. Okay, they were paying to the emirs. That was the way taxation was being done even that time. In the eastern part of the country, okay, they were collecting what is known as egbunku. That's talking about tax imposed before palm oil is harvested, which is compulsory, and so you cannot have it without it. They also pay community tax. Okay, so that's tax levied on every member. So if you belong, or you are an indigene, you belong to a particular community, you pay tax as at that particular point in time. Of course, I must say here that as at that time, they were not meant to pay cash, physical cash. They do some of these things. They were doing some of these things by payment, through physical effort. Some of them will be made to work and on the farm or do some community services, for them to be able to satisfy this particular community tax. So it should be noted here that taxation were not necessarily collected via money. So they were paying all these things as obligatory personal services, otherwise also known as tribute taxes. Now let's look at taxation in the colonial era. Taxation in the colonial era. The first tax that was introduced, it was talking about the first formal kind of a law that was introduced in the colonial era was the Stamp Duties Proclamation of 1903. Okay, Stamp Duties Proclamation of 1903. This was the first tax introduced by the British through Lugard in 1903. Of course, this was also followed by Native Revenue Proclamation of 1906. Okay, Native Revenue Proclamation of 1906, and this was an attempt made by Lord Lugard then to harmonize the tax structure, as much as possible into one, and then this brought about definition of taxable taxes, procedures for collection of, as well as penalties for default. And of course, they raised four questions as to what to pay, whom to pay to, where to pay, and when to pay. All right. So modern tax legislation reform started with the further enactment of Native Revenue Ordinance of 1917 in the northern part of the country, and it was extended to the southern part of Nigeria in 1918. This first ordinance applied to Abeokuta in Ogun State and Benin Edo State in 1927. Okay, and of course it was also extended to the eastern part in 1927. I meant to say, okay, in the eastern part of Nigeria, the initial attempt in 1928 to bring about, this same law into the eastern part of Nigeria brought about the Aba riot in 1929, because the women came out, to fight and to riot against the imposition of taxes, even them, even on the on their men, even at that particular point, in time. Taxation in the colonial era still continuing. The native ordinance of 1917, 1918, 1927 were all incorporated in the direct taxation ordinance number 4 of 1939, which repeat the native revenue ordinance of 1923 edition and native direct taxation colony ordinance 41 of 1937. So the direct taxation ordinance of 1939 could therefore be the forerunner of the modern tax legislations in Nigeria. Under the ordinance, Europeans in the region were not subjected to tax in the region in which they were resident, whereas both the Africans and Europeans in the Federal Territory of Lagos were being taxed. And of course, that brought about Reisman Fiscal Commission of 1958 that recommended the introduction throughout Nigeria of basic principles for taxing, incomes. And the recommendation was embodied in Nigeria Constitution Order in Council of 1960 and formed the basis of Income Tax Management Act of 1961. Taxation in the colonial era still continuing, saying that it is clear to know that the Nigerian tax system, although not properly documented, was virile and alive even before the modernization. Hence, it could not be deemed to be a recent phenomenon except for differences in nature and method. Let's look at taxation in post-independence era. Taxation in the post-independence era. Numerous legal and institutional reforms took place with regards to taxation after Nigeria's independence. That brought about the creation of body of appeal of commissioners, which was established in 1961 for dispute resolution. The Joint Tax Board was also established with that same year with the primary responsibility of ensuring uniformity of standards and application of personal income tax. The notable change of this particular modern trend was the Income Tax Management Uniform Taxation Provision Decree number 7 of 1975. Of course, we're saying here that after independence, a lot of reforms, a lot of legal frameworks were brought into the system, just to ensure that there is a harmonization of different taxes that were being in operation, that were being done in operation, that were in operation then, before post-independence, before the independence era, bringing them together to form a sense of give a sense of direction as per how taxes will be collected in Nigeria. All right, so let's go further as we talk about post-independence era. Still, in 1985, the federal military government promulgated the National Taxation Provision Decree, otherwise known as Decree 4. Of course, that law increased the personal allowances and empowered the tax authorities then even to collect or get information from the different banks about customers. And what do we say here? The what happening today that when tax authorities could just go to your bank just to get access to information about a particular taxpayer, did not just start today. It started way back. In 1992, government introduced self-assessment scheme, and features of the 1992 amendment also include tax incentives up to the unit trust, application of excess profit tax, increase in personal income taxes, increase in taxable tax rates for personal income tax, introduction of rural investment allowance, and treatment of withholding tax as an advance payment of tax. Okay, so talking about taxation in the post-independence era. In 1993, the personal income tax decree one was promulgated to replace the old income tax management act of 1961, and the features, of course, have been stated there. Increase the table of rates for taxation for individuals, expansion of taxable profits to include profit arising from a trade, business, and profession or vocation, as the case may be. Now let's look at recent things still happening today. Major trends in taxation in Nigeria over the years now. Nigerian tax system has undergone several reforms and changes, and this has led to different, changes in the relevant tax laws. This is with a view to repeal obsolete provisions and simplifying the main ones. Okay, that's what we see here. That over time in the modern, times in Nigeria, there had been reasons to change the existing laws in order for the obsolete ones to be repealed and for, of course, to bring about a simplification of the main ones. All right, and we're saying here that taxation in the modern, Nigeria was broken down into three different compartments. To say that three different tiers of the government, that's the federal, state, and local government, have been given the authority to collect taxes, based on their different jurisdiction. All right, and the major tax laws as of February 2019 on various related amendments include Personal Income Tax Act of 2011, Company Income Tax Act of 2007, the Petroleum Profit Tax Amendment Act of 2007, Value Added Tax Amended Act of 2007, Education Tax Act of 2004, Capital Gains Tax of 2004, Customs and Excise Management Act of 2004, Stamp Duties Act of 2004, Taxes and Levies Approved List for Collection Act of 2015, and of course the overriding law as at that time, has to do with 1999 Constitution of the Federal Republic of Nigeria. And let's look at the new Finance Acts. Recently, Nigeria government embarked on the enactment of acts, okay, to on an annual basis to bring about active monitoring and fiscal policies with a view to stimulating the Nigerian economy and also serve as an impetus for sustainable development. Seeing here that in recent times, Nigeria government, started to talk about, annual finance arts. So every year now, there is always a new art, finance art, brought about by the Nigerian government. And of course, the major reason is just to monitor fiscal policies, to bring about further development in, fiscal policies, changing of policies, with a view to stimulating the Nigerian economy, just to make sure that everything is on a sustainable development. Okay, and the Finance Act of 2019 and 2020 made significant changes to the existing laws, even as at that particular period. The amendments made by the Finance Act were intended to raise necessary revenue required to defray public expenditure, support sustainable increase in public revenue, and ensure that tax laws provisions are consistent with national tax policy objectives of the federal government of Nigeria. Basic feature of basic features of the Finance Act 2019. Basic features of the Finance Act 2019. Several features were brought into the 2019 Finance Act, and of course, some of them have been listed here. We have the fact that new companies' income tax rates were brought into play. Okay, initially before now, we were having just one single tax rate, that's 30%. Okay, but now they have graduated it based on the different tax bands, different income bands of the different organizations. Okay, so that led to exemption from company income tax, of some categories of profit. Profit, of course, talking about when you generate profit and your revenue is in a particular band, okay, you could be exempted. So in Nigeria today, if you have revenue from 1 to 25 million, you are exempted from paying tax, company income tax. And then if your revenue band is from 25 million, okay, and above to 100 million, you're going to be paying only 20% as income tax, to the government. Okay, and then if it is beyond 100 million, then you retain the 30% income tax rate. Data transaction and service rendered by non-resident companies. Saying here, look, there are so many international organizations that are doing businesses in Nigeria, but of course they are not resident here. And of course, the Finance Act 2019 now says that if you have a significant presence in Nigeria, you don't have to be resident here. Look at what is happening now between Nigeria and Twitter. Okay, so if you have a significant presence in Nigeria, you don't have to be resident here, you don't have to be incorporated here before you are subjected to tax. Okay, that's what that means. Tax bonus on early payment of tax. If you That means if you pay your taxes, that's company income tax, before if within the first 3 months, okay, after year end, then you'll be given a tax bonus. Commencement and cessation of business rules. This one has been done in such a way that, look, there is no more overlap. Okay, unlike before, when you do commencement, the tax for 1 year could be subjected to 3 different years of assessment. Then it's saying here, look, we have to, it has been modernized in such a way that there's no overlap any longer. If you start business, for example, in July, okay, so and your year end is December, the first year of assessment will be the following year, and then you'll be taxed based on those 6 months. Okay, the second one will be the second year of operation, and so there was no overlap between July and the following year end before you are subjected to tax. Okay, so minimum tax has also been reviewed. Unlike before, when you have different rates being graduated, talking about total asset, talking about revenue, talking about turnover. Now it has been simplified. Minimum tax now talks about 5.5%, 0.5% of your turnover. That is the minimum tax rate now. But of course, because of COVID, if you do and you file your tax between 2020 and then 2021, that's for 2020 year of assessment and 2021 year of assessment, you are going to pay only 0.25% of as tax, minimum tax. Professional levy has been abolished. Instead of paying what used to be 20%, 20,000, 25,000, it has now been abolished. So think capitalization, reduction of withholding tax rate on construction is now 2.5. That, unlike before when it used to be 5%. And the value added tax changes too. It has been increased from 5% to 7.5%. Those were the basic features of the Finance Act of 2019. Let's move on to the next one, talking about the types of taxes in Nigeria. We have personal income tax. Personal income tax is on chargeable income of an individual, which is the aggregate income from all sources, whether from employment, investment, profit from trade, profession, or vocation, after deducting all non-taxable incomes and relief granted. Okay, so that talks about personal income. So everybody who is earning money, either from employment or from investment or from trade or from any other thing, you must be subjected to personal income tax. It's a tax based on what an individual is earning. Okay, and then of course the principal act has always been ISMA. That's the Income Tax Management Act of 1961. Of course, there have been several reviews, concerning that particular law even now. The Personal Income Tax Lagos Act, as a then, was enacted to deal with taxation of residents on the Federal Territory of Lagos, armed forces, the police, and the officers of foreign service, and non-residents. All right, so there have been several amendments that have gone into personal income tax act. The federal revenue today is mandated to collect personal income tax from residents of federal capital territory, and of course from Ministry of Foreign Affairs, and then other residents who are foreigners who reside outside the country and earning income in Nigeria. Expatriate workers residents in Nigeria, police officers, and military officers in Abuja. Okay, they are all paying their taxes to Federal Inland Revenue Service. Companies income tax. Company income tax is a tax imposed on the profit of companies, excluding profit from companies engaged in petroleum operations. You must take note of that. Okay, it's a profit on all income. Okay, profit on income or profit of companies, corporate organizations, but then excluding those that are engaged in petroleum operations, accruing in, derived from, brought into, or received in Nigeria in respect of any trade or business, rent, premium, dividends, interest, royalties, and any other source of annual profit. Okay, Now, company income tax is currently being collected under the provision of the Company Income Tax Amendment Act of 2007. This has its principal act, the Companies Income Tax Act of 1961. You can see the genealogy of how it started and the different amendments that have come up over time. Of course, the tax laws now, the new provisions regarding Finance Act 2019, 2020 are now applicable when it comes to companies' income tax. All right, and we must say here that the Finance Act had, like I said before, had already segregated income tax rate based on different income bands, like I've also explained before. The Federal Revenue Service is the only institution that is mandated to administer this particular tax. The next one is Petroleum Profit Tax. Now we talked about income tax the other time, okay, being income based on profit. I would say excluding those from petroleum operations. Now we're saying here that petroleum profit tax, this is one which is one of the oldest taxes in Nigeria. Okay, is the one that has been, put in place or that have been enacted, or the law. I'm talking about income from income tax from petroleum operations. Okay, and petroleum operations has been defined, according to that particular act as mining or obtaining and transportation of petroleum or chargeable oil in Nigeria by and on behalf of a company for its own account by any drilling, mining, and extracting or other like operations or process, not including refining at a refinery, in the course of the business carried on by the company engaged in such operations and all operations incidental thereto, any of or any disposal of chargeable oil by or on behalf of the company. You must take note of this particular definition talking about petroleum operations. So we're saying here that Petroleum Profit Tax, Act of 1959, all right, saying that this is the basis and this is what is being, subjected to tax. Income derivable from petroleum operation. And then there's been a specific definition given to petroleum operation. So that means that, for example, if a company is into oil and gas, but it's not into mining, it's not subjected to petroleum property tax here. If it is just in the marketing that we have them all over, okay, those ones are meant to pay what is known as company income tax. But then if you are into mining and you are bringing in petroleum, and transportation of petroleum or chargeable oil in Nigeria, then you are meant to pay petroleum profit tax. Petroleum profit tax is charged at 85%, as you do your export. So that is talking about petroleum profit tax in Nigeria. The next one is value added tax. Value added tax is an indirect tax that is based on consumption. Value added tax came into being in Nigeria in 1993 with the enactment of Value Added Tax Act of 1993, but its implementation actually began in January 1994. So what does that mean? Each person is required to charge and collect VAT at a flat rate of 5%. That is talking about authorized person. And person here means organization. So we are to charge VAT and then to collect VAT on behalf of the government. Value tax was intended to eradicate completely many other taxes related to goods and services, especially sales tax. Okay, so everybody who is buying and selling one way or another, you are meant to charge VAT or pay VAT, and there are appropriate penalties for failure to do just that. When you charge VAT on sales, then it's called output VAT. When you charge, when you pay VAT when you buy goods or you buy products that you want to resell, then it is called input VAT. At the end of the month, you are expected to do what is you are expected to file, your VAT returns. So when your output VAT is higher than your input VAT, then you pay the difference to the government. That's what the government is saying. Now, VAT is not to be borne by you predominantly. What it means that you have collected and you have also paid. You are only to deduct what you are paid from what you collected, and then make the difference and pay the difference to the government at the end of the month. That is what the rule says. So everybody is paying one way or the other, but when you are paying, the person you are paying it to must make returns at the end of every month. The next one is education tax. This was introduced in 1993 as a special tax on corporate income, specifically to fund the upgrade of infrastructure and facilities in the education sector. Okay, so every government, every company that's operating in Nigeria is entitled to, should pay 2% of their accessible profit as accessible profit, to the government, so that we'll be able to fund the educational system of of the country. Okay, that it came about by a decree in 1993, just to help as much as possible to fund education in Nigeria. Education Tax Act was repealed by Education Tax Act 2, 2004, and it's not worth to mention that Tertiary Education Trust Fund Act, Establishment Act of 2011 was enacted to repeal Education Tax Act 2004. Okay, capital gains tax. Capital gains tax is tax, okay, levied on individuals and corporate bodies when gains arise from the disposal of capital asset. Capital gains tax was introduced in Nigeria under the provision of Capital Gains Tax Act of 1967, and applied throughout the federation and and companies inclusive. So it means that when you buy and sell capital asset, every gain that you make from it, you must subject it to capital gains tax. Okay, subject to capital gains tax. And of course, we capital gains tax is 10% on whatever it is that you have made, from the gain. It's 10%. Now we must say here that it is a concurrent tax. It means that so federal government and the state government are given the authority to collect capital gains tax. So why state government collects on individuals and on non-incorporated businesses, federal government collects from residents of federal capital, and of course from capital from corporate organizations. So it's still 10%, even as we speak. So that brings us to the end of the history of taxation in Nigeria. Okay, today, and I want to say thank you for being part of it. Um, Please subscribe, like I've said, to the YouTube channel. Okay, my YouTube channel. You can make comments there. You can also give your own, give at least one or two comments there, and which I will definitely respond to, as much as possible. Thank you very much. And next time we'll be talking about. Next time this class will come up, we'll be talking about tax administration in Nigeria. Thank you. Bye for now.